SARE National Session. We do these to inform you, to educate you, to enrich your life in some kind of way, typically in the form of business. So my name is Jenny Ann Chondo, and I am here as the host and moderator. And today we are talking about the 5 C's of credit. So this is actually part 1 of a 2-part series. Part 2 will be coming out next week. This week's session will be out on the YouTube channel in the next week. So you'll be able to watch both of them back to back to be able to really get the wealth of information from our expert today. But let me tell you about Isaac Elizondo. He has worked in the banking and financial services industry for more than 18 years. And he's not just been working in the industry, he's actually award-winning in the industry. He's won several awards in retail banking for his goal-setting achievements. Now, prior to this banking career, he actually worked in commercial real estate, mostly in land acquisitions. So doing that, office leasing, development, that sort of thing. So if that's something that's sort of in your wheelhouse, you're really going to connect well with him. He was also a small business owner for a short time in the insurance and financial advising field, and then later sold his company and joined one of the largest community development financial institutes in the United States as regional director. So he's kind of done it all. So he really relates to people who are in that small business ownership component, but then also has that financial advice. He is now working with United Texas Bank, promoting CRA loans, also helps women, minorities, and low to moderate income folks to get their financial situations figured out. So I am going to sit by here and become a participant with the rest of you as we hear this presentation. Okay, Isaac, welcome. Good to have you, and I'll let you take it away from here.
Thank you very much for the introduction, and I appreciate that. And good afternoon, everyone. Thank you so much for joining us today. And thank you to SARE as well for allowing United Texas Bank to participate in their webinar series. We really appreciate it being here. So again, I'm Isaac Elizondo, Small Business Development Officer with United Texas Bank. And again, I'm responsible here at the bank for helping women, minority, and low to moderate income small business owners obtain small business financing. Again, thank you for joining. We really appreciate that. And as Jenny did mention, this is a 2-part series. The 5 C's of credit, as we see right here, we'll discuss here on part 1, and then we'll go into the second part, credit reports, the business lines of credit, business working capital and term loans, kind of more about what they look for, and then how to use them responsibly so that you can get them renewed, et cetera, et cetera. And so just want to keep that in mind. So let's go ahead, and with that, let's get started. All right, so understanding the 5 C's of credit, right? So here's one thing. I like this slide right here. As a business owner, these are things that are always on your mind, right? Okay, you have office space or warehouse space, retail space. Where do I get it? How much is it going to cost me? Well, now I got to get a commercial realtor or a realtor to help me out to locate the space. Okay, equipment. Now I got to put equipment in there. I got to put supplies. Wow, there's a variety of things, right? So warehouse, you'll need machinery. Your retail space, it's a restaurant. You'll need stoves. You'll need tables, et cetera, et cetera, et cetera. You're an office space, desks, chairs, et cetera. And of course, then you got communications on your mind, right? How are we going to get out there? How are we going to brand ourselves? Okay, great. Now I have utilities, right? I got to set up the water. I got to set up all the billing, the phones. Everything's got to go into place. You have licenses and permits. There's a lot that goes into even before you open the doors. You have insurance. You're going to have to get employees insured. You're going to have to get the building insured. Again, it's on and on and on with insurance. I can go on for an hour, actually. Lawyers and accountants. You're going to have your team. You do have to have a bookkeeper, accountant. You got to hire the right people. Again, go back to inventory. You're going to have employee salaries. Again, advertising and marketing, which we talked about, communication, right? How do we brand ourselves? How are we going to start? Where are we going to advertise, right? This is going to be digital. It's going to be on billboards. What's it going to do? Market research, existing businesses, obviously you wanting to expand, take it to the next level. You're going to need that market research. If you're starting a business, yeah, you're definitely going to have to do a lot of market research before you start, but that takes a lot of time. These are things that are constantly always on your mind. Again, well, printing marketing materials, right? Do we print social media? Making a website, creating the website. Is it an interactive website? What goes into that? And of course, last one, expansion. If you're an existing business, moving on to the next step. Anyway, trying to make a point here is you have a lot already on your mind, and there's just so much. And so now we're just going to add a bigger one, a huge brick to what you already have, funding, lending. And of course, a lot of this stuff, office space, equipment, advertising, marketing, insurance, accountants, etc. All of this actually is tied in together, and it is based through funding as well, right? You're definitely going to need some kind of funding of some sort besides using your own cash, right? So again, a lot on your mind, and of course, funding obviously being the big one. So let's talk a little bit about that and what types of funding sources that you might think about. So, for small business loans, there's a variety of different funds, right? There's conventional. So, conventional really is non-government backed SBA type products. So, conventional is just it's the bank's money. That's it. And of course, then you have government loan programs, government grant programs. Again, I'll go back to SBA. That's Small Business Administration. That's government backed loans, right? But it's SBA funding through the banks, right? So banks really like SBA again because they partner up with the government. If you default, they have a way to recover their funding. So that's one type of funding, right? Of course, I get a lot. By the way, I want to make a note there. I get a lot of people saying they're looking specifically for SBA funding. That's great. Don't worry about that. A lot of banks are going to go in that direction and are pretty much going to automatically put you into that. Because again, if you default, they actually get a large percentage of their money back. And so a lot of banks actually like that kind of funding. They also have really good rates as well, but that really depends on the bank. We over here at United Texas Bank, we are a conventional lender. We actually don't do SBA loans. And so we do fairly well actually with our rates. But again, just depends. There's medium banks, large banks. Everybody kind of deals in different arenas. So just want to throw that out there as well. So yeah, and apart from the banks, government loans, conventional loans, SBA loans, you have alternative lending. So alternative lending, I did put UTB there technically because we do have a special program here that is considered alternative lending. So I'll leave us there. But what they're really talking about is other alternatives such as community development financial institutions. Those are called CDFIs, right? So CDFIs were actually created back in 1994. There's a variety of different types of CDFIs. There's mortgage CDFIs, there's small business, there's real estate, and then there's automobile type CDFIs. So there's a variety of different types of CDFIs out there that are really focused on helping those that can't seek financing through traditional means, such as a bank or a for-profit lender. So that's an alternative, and they predominantly really work with startups. So if you are a startup, you definitely want to go into this field. They can definitely help you out. Unlike a bank, unfortunately, a lot of the banks, almost all of them, 100%, only work with companies or businesses that are 2+ years in business. So you might be limited in that way. So that's the types of organizations and funding that we have. And of course, there's credit cards. Again, I've seen it happen before. It's not advised, but you do what you got to do if you're starting your business or you need immediately. So credit cards can be one way of funding your business. There's also called crowdfunding. This is actually unique. It's been around for a while and it is popular. The more popular one was Kickstarter. Again, that's people, you give them your idea, this is what I want to do, and people start giving you money. And of course, sometimes there's a return, like those you're printing shirts or something, and you'll like give them a free shirt if when their business is up and running. You'll give gifts out like that. So Kickstarter's a really popular one. So that is crowdfunding. Another way of funding your business would be selling ownership in your company, right? Giving a percentage out, 5%, 10%. Actually, a great example is the Shark Tank. That's a really good example as far as business owners trying to sell equity. They're trying to create funding for themselves by selling a percentage of their company to one of the sharks. So that's another one. And of course, self-fund, that's just self-funding. So it's what you have in your savings and your checking account, and you can go about it that way. Although I don't really recommend something like that. I think cash is king. Holding on to your money is important. And on top of that, a lot of banks and a lot of lenders, whether it's nonprofit or for-profit lenders, they really want to see liquidity. They want to make sure you do have funds in your account. So I think holding on to your money and then just taking out a loan or a line of credit with an organization, a bank, or wherever can actually help you a lot better. Also, you know that cash will eventually run out. And I've seen this in the past where they're self-funded through the whole way. They spent every cash, everything that they have, and then they come to us and they actually want a loan or a line of credit. Keep in mind, there are some organizations that require you to have 10 to 20% of of liquidity for whatever you're going to borrow. So that's something you have to really be careful with. Every lender is different. CDFIs have those types of requirements as well. And so you just really have to be mindful for that as well. So just think about that. All right. So those are, sorry, second, funding sources. So, and okay, so next, what do lenders ask? How will the loan be paid back? That's that's one of the questions that they're going to be thinking about. So from the business or the personal income, and of course, making a note of that, there are some business owners that do have a full-time job, especially if you're a startup. We're a bank, we don't work with startups, but there are CDFIs out there that require you to have personal income and you must have a job before applying for a loan. It's just a requirement. Again, they want to be paid back. And so they're looking for, income coming in. Doesn't matter if it's from the company or it's from your job. They want that coming back. So how will the loan be paid back is what they're going to ask. What will secure the loan? This is a big one and a challenge as well. So most lenders will require collateral, predominantly a lot of them. Now there's some CDFIs out there and some lenders actually that will not require any collateral or secured up to a certain dollar amount. And it's a variety. Just so you know, here at our bank, for our special loan program, we actually are uncollateralized, so it's unsecured on some of these lines of credit and other types of things. So that's one. But again, we have a lot of banks, CDFIs that kind of work differently. So keep that in mind. A third question there is what is the risk? So think about that in your company and your business. What, how does your business look in general, as far as financials or your industry overall? Think about the risk. So, and again, I'm trying to, you ask these questions, put yourself in the lender's shoes, right? What is the risk? Where could this fall apart? Will the business succeed? That's another major question. How will it succeed or not? And again, that's subjective. Again, you can kind of we're going to look at the numbers, look where you're going, look at projections. There's a variety of things like that we'll look at. Are you a good borrower? That's another question that is definitely asked by every single lender. And of course, are you a good borrower? We're going to look at history, right? Your credit reports. We're going to look at tax returns, different variety of types of financials there. And so you just got to be mindful of that, right? And again, this is what I was talking about earlier. I got ahead of myself, right? What is your contribution? So liquidity, that's really important, right? You know, how much do you have in savings? How much do you have in your checking account? It's really important that because we know for a fact, hey, we're giving you the loan, and if the loan finishes or the line of credit uses up the line of credit, you know, do you have funds? Do you have money to support that, right? For for down cycles or depending on your industry, right? So those are things you definitely want to consider and think about when they do talk about what is your contribution to this. That's what we mean. And in the final, in the end, would you lend to yourself? you know, Overall, I mean, look at your business, look at your history, look at everything, would you lend to yourself? Because I always like to say, would you lend to your aunt or uncle? Would you lend to a family member? That's interesting. I get a lot of different types of answers. No way, absolutely not. Put it in that perspective. Again, it's a family member, or, how would the lender, would we lend to you? So again, put yourself in their shoes when kind of assessing these types of questions and looking at it. And of course, right now we're about to take a deeper dive into this as well, as far as these types of questions. What will secure the loan? What is the risk? Will the business be successful? We'll take a deeper dive here. All right. So moving on. All right. All right. So understanding. So the 5 C's of credit, right? So understanding the 5 C's of credit. The 5 C's of credit is really a method of evaluating a borrower's or company's both qualitative and quantitative measures. All right. So lenders may look at borrowers' credit reports, credit scores, income statements, and other business financials, and so that are relevant, right, to the company's standings. They also consider information about the loan itself. So, first of all, before I get ahead of myself, I did use the word qualitative and quantitative. Okay, so what is qualitative analysis? So, in business and management, qualitative analysis uses more a subjective judgment to analyze a company's value or prospects based on non-quantifiable information. So, such as management expertise, your biohistory. This is years in the business, industry cycles, strength of the business industry, strength of the business itself, right? There's also research and development, environment of the industry. So that's more qualitative, right? Now, contrast with what I said before with quantitative analysis. So, which this mostly quantitative really focuses on the numbers found in the report, such as a balance sheet, income statement, your tax returns, your personal financial statement, et cetera, right? So these qualitative and quantitative, the two techniques, however, will often be used together to examine a company's operations and evaluate its potential and its overall ability to pay back the loan and therefore qualifying the loan. So it's a combination of these two analysis. So yeah, the 5 C's. This is a system used by lenders to gauge the creditworthiness of the borrowers and owners of the business. The system weighs 5 different characteristics of the borrower and conditions of the loan. So attempting to estimate the chance of default, right? And so consequently, the risk of a financial loss for the lender. So the 5 C's of credit are character, capacity, capital, collateral, and condition. And I want to go back to saying what I just mentioned right there. We're measuring banks in general, CDFIs. We're measuring whether you will default. That's what's being measured. Try to think about it in that way. Some people get upset because they didn't get a qualified for a loan, or why didn't I, or how come. It becomes very frustrating. Try to think of it as, wow, thank you. If you would have given me the loan, I probably would have defaulted on it. So think of it that way, because it is very true. So, again, as I mentioned, right, character, capacity, capital, collateral, and condition. So capacity, right, that's we assess the borrower's debt to income ratio. Capital, right? This is indicates the borrower's level of seriousness, and we'll take a deeper dive on all of these, by the way. Uh, and collateral, again, offers the assurance that if the borrower defaults on the loan, the lender can repossess the collateral that they put up. Character, again, AKA, we like to say credit history, but character also means us meeting you face to face, get a kind of feel for that person, right? That's kind of a qualitative measure. Credit history, AKA financials, that would be the quantitative, right? So that would be character. And then conditions, factors like the interest rate or the amount of principal or even physical, like opening a snow cone shop or an ice cream shop in the middle of December or January, right? That's conditions, right? How are you going into the market at that time? And again, just really depends. So yeah, let's move on, take a deeper dive right here, and we will start with character. Um, And just to circle back really quick, sorry about that. I do want to make a note though, for debt to income, for assessing that, a lot of people have a question on that. That really depends. There's a lot of banks have different criteria, and also it depends on cash flow. I mean, if we think about a mortgage, a lot of lenders actually think about 35% or less, money left over to spend for savings or to after you paid your bills. 36% is good, 49% DTI, debt to income ratio, is adequate, but you do have a little room for improvement. There are some lenders out there that will do up to 55%. It really depends. Okay, so I want you to think about that when debt to income, that plays an important role as well. Again, we'll take a deeper dive into that. Right? And so let's go and get started. So yeah, first one again, character. Are you honest and reliable? Right? So the first C more specifically refers really to credit history. We'll get down to it, which is really the borrower's reputation or the track record of repaying debts. And this information really appears on the borrower's credit report, right, which is generated by three different credit bureaus, Equifax, Experian, and TransUnion. So the credit reports contain detailed information about how much an applicant has borrowed in the past and whether they pay loans on time. I know in part two, we will dive more into these three credit bureaus, okay? So I'm just touching a little bit on it, but just so you know, again, it's all tied to character. So the reports also contain information on collection accounts, bankruptcies. They retain most of the information for about 7 to 10 years. And so information from these reports help lenders actually evaluate a small business credit risk. Again, everyone's heard the FICO score, right? So it uses this information found on consumers' credit report to create what's called the credit score, and a tool that lenders use for a quick snapshot of creditworthiness before looking at credit reports. I do want to say there are different banks have different numbers. It really depends. Right now banks out there are some at 680, right? So if you apply online and if you're below 680, it'll automatically decline you. And actually, because of our environment in the last couple of months, I believe that's actually gone up maybe to 710 or actually 720 already. So yeah, and so anything below that, you're automatically declined, and you're not even given a chance to explain certain things. What if you're at 700? What if you're at 680? What if you're right there? But it does that. CDFIs, other lenders, again, they could be maybe a little lower, 640, right? So they might have a little lower score. So it really depends on the lender. Here at United Texas Bank, we actually don't, in our special loan program, we actually don't offer we don't have a credit score. We do look at your credit report, but you're not declined because you were at 680 or 650 or 600. But we do look at your credit report. We look at the history of it, and it's really important for sure. It tells us a lot about yourself. So again, as lenders want to see that you've established financial track records, right, along with evidence that you can pay back a loan. A credit history really will show a lender, have you, what other borrowers have you borrowed from? How much have you borrowed? If you carried reasonable balances as well, and if you made payments as agreed upon. So we do want to measure that. Uh, let's see, have you managed your credit responsibly? Again, it's important to make payments on time. And of course, with bank credit cards or lines of credit, keep your balances low relative to the credit limits. That's really important. Not just that, are you using them wisely? Are you maxing them out? And of course, at last, setting up a dedicated business account, as lenders want to see how you handle both your business and personal finances separately and responsibly. And one thing that we're coming into, a problem where we see this a lot is where I'm a sole prop and I conduct my business out of my personal. Yeah, you really can't do that. You got to have your personal and the business separate. Even in that instance, they want to see that. A lot of the CDFIs I'm aware of, they like to keep those separate. And if you don't, unfortunately, we're going to say, okay, well, you got to go back to the drawing board, open a business here, your business account, and then kind of start from scratch. And then they gotta measure it. That's the only way to do that. Uh, so again, probably character. We drove into character, and there was a lot that we discussed as far as FICO scores and credit ratings. And so again, part two, we will discuss that in more depth. Okay, let us move on to capacity. So capacity, right? It measures the business ability to repay a loan by comparing cash flow against recurring debts and assessing the borrower's debt to income ratio. There's that word again, right? DTI. So, and that there's a variety of things as far as capacity, right? Now, before extending financing, really a lender will want us to ensure the business has the ability to repay a loan to meet payment obligations. So profitability and cash flow are essential components of demonstrating that your business has the capacity to handle new credit, right? A business must have enough positive cash flow to meet both short-term and long-term commitments. And a lender will carefully assess the cash flow of a business to gauge the probability of repayment. So capacity is really, can you meet these obligations? And think about it this, it's not just your business, it's actually on the personal side as well. You really have to make sure that you have the capacity to repay all your personal things first as well, right? Not just your business. It's seen it on both sides. And so your business is fit, but then you have a lot of your personal side really kind of out of control. There's a lot of debt. There's a lot of things on the consumer side. There's more cards than you need. You have more credit cards than you need. There's a lot of debt on there. It could be school loans, whatever. That could lead to some problems. But one thing I want you to know about all lenders, nobody wants to give anyone a loan and create more problems. It's additional debt you're taking on, and then all of a sudden that's the thing that kind of breaks everything. That additional debt is, hey, I got a loan, but now you got a big burden. I got to pay it back. So understand that, banks and all lenders are really looking out to make sure that doesn't happen to you. Think about that in those lines. Moving on to, sorry about that. Capital. Sorry about
You're
that.
totally fine. You're allowed to take breaths and drinks of water.
And we're okay on time right now? Are we still good?
You're doing great. Oh yeah, this is perfect. We're all ears here. You're doing great.
Okay. Excellent. All right. So capital. Again, lenders also are considering any capital that the borrower puts towards a potential investment. Large capital contributions by the borrowers decreases the chance of default, right? So when a lender sees the owner invest money in the business, it shows that the business owner is committed to succeeding. And what's more, a business owner with assets that can convert it into cash in case of a sudden downturn in revenue will be better able to operate his or her business and repay the debt. So a lender wants to see that the assets of the business sufficiently exceeds its liabilities and understands how quickly and easily those assets can be turned into cash. Um, uh, yeah, so this can really make a lenders more comfortable about extending credit. So the capital is a really a big deal as well. And by the way, again, I'm going to go back to like for-profit lenders, nonprofit lenders, and banks in general. We're all different. Some people will require X amount of collateral. Uh, some will require less. Some actually don't up to up to a certain dollar amount. Um, so it really depends on the bank itself. And so that's where getting to know banks, lenders, kind of immersing yourself into that world. Now you say, Isaac, my business is fine. I don't, I'm not going to need that. I'm not going to borrow money. And if I need to borrow money, I'll just go to the bank at that time. Yeah, that's the worst time. When you're running to the bank and saying, I really need some money, that really sounds desperate. And of course, we can look at the numbers, and it pretty much says exactly what situation you're in right now. So that's my experience with that. So I always tell everyone, get the funding when you don't need it, and don't get a loan, right? Get a line of credit. Just get a line of credit. It's whatever. It could be $5,000, $10,000, a small line of credit. You already have an established relationship with a bank. And that is what, when they're talking about relationship with the bank, they're talking about a checking account and a line of credit. That's called the relationship. And so you already have it. Say you have, 10,000 and hey, I'm going to need 20,000. Well, you already have the relationship. This is a matter of just, expanding that dollar amount, right? But you're not coming and saying, I need to apply. I need to get all the documents together. I need to get this. Now it's got to go before a review, and then they got to, approve it. And it's a whole process, right? So be ready, get to know lenders, get to know your banks, get to figure out more about what they specialize, your industry specific. You go to a bank and, well, we don't do that kind of loans. Yeah, well, maybe you need to go to a CDFI. Some of them will work, some of them won't. So getting an idea right now, and I would say honestly, 6 months to a year of studying and researching and really knowing, where this funding will come from, and getting something, before you really need it. That's my advice on that. Okay, so moving on. Yeah, we talked a little bit about this. A lot of this sometimes will have some, crisscross a little bit. So I did talk about collateral, right? Uh, Again, it can help the borrower secure loans. It gives the lender the assurance that the borrower defaults on the loan, that the lender can get something back by repossessing the collateral. So collateral, sometimes, often, it really depends. Like you know, we're in Texas. Texas and Florida have homestead laws, so you can't use your personal home, right? But you can use an investment property if you have something. You can use lots. You can use automobiles. Some we don't, but there's some lenders out there, CDFIs as well. You have a car, the title of the car clear and free. You can go ahead and work with a lender securing something in that capacity. So and don't underestimate what you have either. There are some lenders out there that can actually, they'll consider assets your laptop, your desk, your chair, your dry erase board, anything that's in your office is considered collateral. So don't downplay any of that. Say, well, I don't own anything. I don't have anything. There's some lenders out there that will actually look at everything and, can put a dollar amount to that. And so think about that. And especially with small businesses. As a small business, a lot of people have that mindset that I don't have anything and I'm a small business. And you really should get out of that mindset. You believe it or not, you have quite a bit. And so, and especially if a small business, you're looking at a $5,000 line of credit or a $10,000 line of credit, you can start there And you never know, 3, 4, 5, 10 years down the line, there you are, uh, using 350,000 line of credit or a $500,000 loan. So it's little steps, little by little. But anyway, going back, that's collateral. Um, and let's see, the last C is condition. So again, so in addition to examining your income, lenders really look at the general conditions relating to the loan. This may include the length of time the business owner has been operating, how the industry is performing, the future and stability of the company. We could do that through projections, things like that. Some lenders will take those projections, some will not. So there's several internal and external factors really beyond financial situations that may affect the ability of a business to repay a loan. So for example, the external side, it's a major recession is anticipating that could adversely impact your business. And lenders might factor this probability into their decision as well. Again, the environment that we're in right now, right? So on the internal side, conditions include the borrower's business experience and knowledge. Some cases, you have business references, education are personal factors that can impact conditions as well. Both internal and external conditions can be important indicators of a business ability to survive and thrive, and therefore its ability to actually repay its credit obligations. So I'm thinking anything else as far as conditions. Again, I gave the example there. It's pretty basic. It's, somebody wanting to open up uh, a snow cone shop in the middle of December, right? We're probably going to say, no, you probably shouldn't. You think maybe in July or June, sometime of that. Conditions as well. I mean, COVID is a really great example of conditions in lending. And that was a hard time for every single business owner out there. And some survived, some didn't. But I think COVID was an example. Before coming to the bank, I worked again with another CDFI. It was a really sad story. We was 2 to 3 days before opening. We were funding a really great business, a coffee shop. It was also a children place where children come and paint and paint mugs and do ceramic things, and it was really nice, and it was great to be a part of that. And it was really sad though, it's 3 days before opening, and sorry, we can't fund you. It's impossible. The conditions, you're not going to have anybody in here. If anything, you'll go broke. And so these are decisions lenders will have to make, and they will monitor conditions importantly, and figuring out a little bit what the future looks like. And of course, that was a very dark time for everyone. So that's what conditions are. And so for looking at that, um, and I believe we have come to the end of our 5 Cs. Again, please keep in mind when I was talking a little bit about the credit scores, the FICO scores, we're going to get into that in part 2, a little bit more in depth. Okay. So again, if you have questions now, I don't mind answering them. But we'll definitely have that in part 2 as well. But that's it. That's time for Q&A, end of part 1. So if anybody has anything, uh, ask away. Jenny, do we have anybody asking any questions?
Yes, of course, Isaac. Thank you so much. That was excellent. And I learned a lot myself. So yeah, we'll stick on here and do some Q&A, you guys, for the next like 15 minutes here. So feel free to write in and post your question in. We got one in just right now saying, hey, why do lenders need to look at personal finances for a business loan?
That's an excellent question. Excellent, because we actually do that. We ask for 2 years of personal and 2 years of business. That's kind of the norm. It really, like I said before, it's not just the business itself, but it's your personal income. It's your how you've done personally. Uh, because you are the guarantor. And you as the guarantor, they definitely want to look at your background. And again, that's your tax returns. And that's one thing I want to bring up as well. A lot of people believe, oh, if I set up an LLC or I set up an S corporation, I can walk away. I don't need anything, no, it doesn't matter how you set it up. You're personally guaranteeing the loan, bottom line. And you're on the hook. If you default or anything, you're on the hook. Again, you're the personal guarantor. So we want to see how you stand financially. Very important. It's very, very important. And if you own 20% or more in the business, you are required to be on the loan. So, and 20% or lower, uh, you don't have to provide those financials. So anyway, hope I answered the question.
So that's interesting. I feel like I hear about people making different LLCs or different entities because there's a concept that then they would be personally like
Obligated.
immune if something happened. Yeah, what is that?
No, I have no idea. It's you are on the hook. Everyone is on the hook for the loan. They will come after you. They are not going to go after the entity. And I think, thinking of a Fortune 500 company, right? Amazon brings out a loan or a line, or again, a major energy company, right? That's different. That's something else. That's a whole different type of lending, and doesn't pertain to small business lending. So unfortunately, us here in the regular world, in our world of small business, you're a guarantor, and you will have to repay. Yeah, everyone on there will have to repay. Doesn't matter if it's an S corp, a C corp. There's just no way around that.
How small is considered small, by the way? What's is there an official delineation in your industry that would be, when you're receiving that
Yeah, revenue less 5 million or less in
okay.
revenue. That would be it, I guess, just revenue wise. That's what would define a small business. And of course, different banks have different criteria. It depends on the program. You could 10 employees or less, 20 employees or less, but really it's 500 employees or less, 5 million in revenue or less. You're considered a small business.
Understood. That
So
makes
it's
sense.
yeah, it's kind of big.
Now, you mentioned not to look at credit scores to determine if you will do the loan or not. What exactly do you look at to determine if it is something the bank will do or not?
Yeah, so again, that's for this bank here. I want to make
Sure, sure,
the
sure.
note right there that it's
Yeah.
our bank itself. Yeah, we're not going to take that credit score and say, okay, oh, you got a 600 now. Yeah, we're going to look at, and again, I don't want to take too much of a deep dive, but I'll answer the question because we do have that in part two.
That's right.
But yeah, we're going to look for NSF fees that are popping up. How many times have you been late on a credit card payment, on a car payment? 30 days, 60 days, 90 days. How many and how often? So we'll look at that. Obviously, we're going to look at liens. We're really looking for government liens, tax liens, bankruptcies. How long ago? Yeah, if you had a bankruptcy 2 weeks ago, no, a year ago, no. But it's relative. Hey, and then on top of that, it's not just that. It's why did this happen? Tell me about, okay, you were late a couple of times here or there. What happened? What was your story? So we like an explanation from the borrower. So that's what we'll be looking on. Then again, there could be several other things as we have more questions, but ideally that's what we're looking for, responsibility on the
Sure. So
credit.
it sounds like if they're generally do really well, and then you notice a season where things were not going as well, and they're able to kind of explain it, and that season was
Yeah, we'll
over.
we'll explain it exactly.
Okay. No,
Yeah,
that makes
exactly.
sense. Now, you posed the question, would you lend to you? What if the answer is no? Like somebody's thinking like, I have the best business idea. I mean, literally everyone's going to come to my business. I'm feeling a huge need, but me, I can be a little, risky. What would you say to that person if they realize like, I'm not a good person to lend to?
Yeah. No, yeah, I think, well, if when I say not what I lend to me is like financially, I'm not responsible, yeah, I guess you're right. I wouldn't lend to you. Now, as far as a business owner, preparing before you get to that, I say yes. Everyone needs a line of credit. Everyone's going to be needing a loan. And I do suggest that. I think using some debt to grow is important. And the only way to grow really is with some debt or a line of credit of some sort. That'll help you for sure. I don't know if I answered the question right in that sense. Huh?
No, that did.
Yeah.
No, it totally did. And it's such a good thing for everybody to think about. Just, I mean, shoot, that's a good question to ask for everything from, would I eat my food that I'm cooking? Would I date me? Would I,
Yeah, yeah,
like
there you
be
go.
friends with me? It's a good
And
question to ask.
and yeah, and it's a good time to reflect, would I lend to myself? And
Yes.
the answer is no. Well, I need to really look deep as far as like, okay, why wouldn't I? And then assess it from there. Okay, I know I have trouble with, this cash flow or with this. Then kind of go from that point. Kind of analyze a little bit of what you would fix to make yourself look good for the bank, right? And to be presentable to a lender. So that's a really important. And another thing I want to say when you are talking about that, um, you know, the real thing here is you have to be prepared and know where you stand financially. If you come to the bank, you kind of don't know about your financials, you kind of don't understand where you stand. That's kind of a red flag for lenders, and it'll say it in the numbers anyway. But saying to everyone, just you have to know where you stand. You have to know, where you are in your company, if you're going to borrow money for sure.
Right, right. That makes sense. Now, what if you do have a bad track record? You mentioned some things like low credit score or maybe some bankruptcies or a really irresponsible start where you were just not paying attention and didn't understand the consequences. What's the biggest thing somebody can do to start proving themselves?
Yeah, it's starting over. So it's like, okay, from day one, right? It's May 9th. We're gonna start everything as a clean slate. Lenders, there's different I know in the CDFI world, if you were late on a car payment, um, or a house payment automatically in 6 months, you're automatic decline. So you have to start that 6 months again. You have to make sure you're making your payments, right? For us banks as well, same thing. We would shut you down. You're late on a mortgage or your auto. There's a lot of red flags within the 6 month period, right? So we'd want to see at least a year of of steady payments, for sure. But that's just saying, hey, we need to see a track record between 6 months to a year of just no NSFs. You're making all your payments on time, because obviously that if those things are happening, there's something about to happen that's catastrophic, and you don't need a business loan to. And some people say, yeah, but if you gave me the money, I'll make more money. Not true. Doesn't work that way.
Doesn't tend to work that way, does it? So, what if you have been reliable personally? But have been, for lack of a better term, unreliable professionally. For example, you've paid off your student loans, you always make your car payments, you have a good credit score, but you tried a business and it didn't work and you were not able to pay back a loan or something like that. How does that work?
Yeah. Well, that will affect you, unfortunately. That's sad to hear. But you know what? As an entrepreneur, I mean, statistically, this is actual proven statistics. A business owner will fail 2 to 3 times before they get it right. And so keep that in mind. Your first venture, if that's your first venture, well, the stakes are against you. But then you keep going again, the second one and third one. But yes, unfortunately, that's why I say it's really important. If you get a debt, you got to pay it back because you'll figure out a way because you do have that idea, that next idea. My business failed, uh, but I have another idea. So you want to pay that debt back because honestly, with that debt on your credit report, wow, you defaulted on that lender. Let's say that you're not gonna, do something with us, and so or default on our loan. So that does bring a lot up, and so it's just making sure that you do pay that loan back. In the end, you might have something like that might have to go to crowdfunding to get that, or get an investor, right? An angel investor to come in. Well, I'll tell you what, you'll be the silent partner. You give me 100,000 and then I'll pay you back. You guys work out a term. you might have to go in that direction, you know. And if you're a true entrepreneur, you probably could make it happen.
Right, that's interesting. So it's like if the other business didn't work out and you went through a traditional bank, the chances of getting, obviously people because we know that a lot of people fail, we know that they do eventually get funding
Yeah.
when they fail. And is that how people usually do it, with non-traditional forms without?
Non-traditional means, yeah. And there's other stuff out there. I mean, there's other types of lenders. Again, I'm not an expert on those. I definitely I'm an expert to say, do not go to those lenders, right? You got a lot of these types of lenders where they'll give you 250,000 in 48 hours, but you're paying a 400% rate, and that's a true rate, 400%, 300% rate, and they'll give you funding. It's out there. And I came across, it's in my other company that I worked for, I did come across someone that went to those types of lenders. They're called hard money lenders. And so that's one of them, but they had a really high rate, and they were just, the business owner was just, all their revenue, everything was going to pay this loan back. And they were still thriving. They were still making it. They were making good money. But here they are paying this high rate, and it was ridiculous. Hey, but I needed the funding, Isaac. And they came to us so like to get them out of this cycle. But it happens. It really does happen. But unfortunately, that story ended well because they had positive cash flow and they were really strong. So that did end well, but for the most part, these types of lenders, um, you're going to default and they'll take whatever assets you have and collateral, things like that. So you got to watch out for that. Yeah, it's hard money lenders. There's other types of lenders out there that will, well, of course, I call them predatory lenders. So definitely, I always say try to keep away from them.
Sure, sure. And I think that the types of businesses we're talking about here can be especially vulnerable to what you just explained.
Yeah,
When you're new, like you don't know what you don't know, right? You're just kind
yeah.
of starting out.
I want to give advice straight off that please, whatever you do not Google grants or don't Google funding. Yeah, that can get really, yeah, there's a lot. If you start Googling things like that, you will find those types of lenders out there and they'll pop up on there right away on Google. So I've encountered that as well. So you got to be careful with that.
That's interesting because they're paying for advertising to get to the top of the search
Yeah.
bar, and
Yeah.
they're investing heavily in that, knowing that it's probably a person without connections,
I'm
without a
desperate.
relationship
I
with the
need the
bank.
money.
Yeah, okay, that's really good advice. I wouldn't have thought don't go to Google because that's what we do for everything. So
Yeah.
I really really love that tip. Is there a certain rate that's, and I understand it's obviously going to depend on so many different things, how
Yeah.
much you're asking for and your credit score and your background, but is there a certain rate where you say like if you're getting this high of a rate, you should look elsewhere?
Seriously, if that is a tough one, right? Because there's lenders out there that loan up to 18% and they're credible and they're credible. And so I would say, honestly, if you're borrowing at 22 and above 20% or more, um, it's highway robbery, 27, 30%. Like I said, I wasn't exaggerating. There was an actual rate of 400% rate, and they're out there. So, but again, that it all depends. There's lenders out there that have a variety of different rates, and I know again credible lenders that are at 18%. And so I mean, me personally, I wouldn't pay that high. Sorry, I wouldn't, but just my personal view on it. But they're legit. They're legitimate businesses, right? And so they're credible as long as it's not predatory lending. Yeah, and think I guess above 18%, really, I'd probably stay under that for sure.
Are there any other, obviously we've shared your contact information here, which sounds like you're going to be a great resource for people who are looking for funding and everything. It's in the chat right now, but is there any sort of things that people can look out for, other signs? 400%, that would be a sign of
Well,
not a great lender.
that's Yeah, Jenny. Well, that's the thing, though. That 400, there are some lenders where you borrow the money, you get funding, but they won't show you the contract till after you receive funding. So you won't know the rate till afterwards.
Is that legal?
Yeah, well, you know what? They're working, they're operating, and yeah, you're right. It shouldn't be. And I haven't kept up with whether, there's legislation being passed. Should be, definitely should, but no, they're out there, and that's what's happening. That's how you're getting lured into this. And now I got a rate. I didn't know what it was, but I needed to get the money. Then I can get the rate and the contract and everything. So yeah.
That
Um,
is really frightening. Did do most banks show you the contract ahead of time, or
oh
most
yeah,
ins-
absolutely. I mean,
institutions?
banks, yeah, banks, lenders, CDFIs, yeah, they will show you everything up front, and you will know. And of course, as a lender, I'll go through that with you as well. Well, actually, our conversations right up front. I'll tell you exactly what rate you're getting on a line of credit and a loan. So yeah, I'll tell you right up the front, especially with our loan programs. So
And how
they
long does
should.
that process usually take with somebody who's working with you? How long does that process take from if they show up, like you said, show up educated, show up knowledgeable about what you're coming to the table with? How long does it usually take, if you do
Well,
end up getting funding?
yeah, that's a great question. And honestly, it really, like I said, it really depends on the business
Yeah.
owner because some of them have a little more things in order, some don't. Oh, I need this, I need that. And then we start asking questions. You've given us your packet, and we have other additional questions. Now, honestly, I here actually where I'm at here at UTB, we did one in a line of credit in 3 weeks, but everything was provided to us. They had the whole package. We had a couple of questions. You know what? This looks really good. They provided a document. We got everything in 3 weeks done. So that's pretty quick, by the way. Industry standards, that's very fast. But again, everything was squeaky clean. And we've been here where something took 2 months and 3 months actually, and that's totally not our fault. That was really the business owner needed to get this and that, and oh, we don't have this. We got to put it in order. Um, yeah. So those, yeah, on our part we're 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 running pretty smoothly here.
You're ready to rock.
Yeah.
Isaac, this has been really interesting, and I think that it's good that we have a second session because there's so much more to talk about. Really
Yeah.
appreciate everything you did today. Thank you so much.
Yeah, absolutely. All right. Thank you, everyone. Appreciate it. Again, any questions, you have my number, my email address, reach out to me. Appreciate it.
That's awesome. So, you guys, part two is next week, 3 p.m. Central Standard Time. We will get part two of this presentation. We'll be able to ask some more questions again on the back end and really, do a deep dive into it. This session, if you have more questions about it, or if you feel like you need another run through, or perhaps you want to send it to your business partner or send it to somebody else that you know, it will be out on Sarah National's YouTube channel by Wednesday. So the day before part two. So very, really nice to do a refresher, watch that one, and then head in for part two. But we will see you there, same time, same place. Bye, everybody.